This is your LMAX Exchange technical update for Wednesday, April 26, 2017. Euro dollar. So the euro continues to extend its run to fresh 2017 highs following this latest break above the previous peak at 109.06. The break is a significant development and should be watched closely as it strengthens the prospect for the formation of a major base in the euro, which could now open the door for fresh upside over the coming days and weeks up towards 115. The market had been showing signs of an inverse head and shoulders formation several days back, which was initially broken before pulling back. The pullback, though, was supported ahead of 104.95 to set up a higher low at 105.70, which was confirmed on the break above 109.06. So this now sets the stage for a move towards the 112 to 114 to 115 area over the coming days and weeks. And any setbacks that we do see between now and then should ideally be supported well ahead of that 105.70 higher low, ideally somewhere in the 107 area ahead of the next major upside extension. At this point, it would take a break back below 105.70 to negate the constructive outlook, but at the same time, there is risk still for setbacks before the market heads higher. So it wouldn't be worth looking for the market to extend much after this impressive run, with the possibility for a pullback now before the market considers trading higher. Again, the constructive outlook is intact and following this break to fresh 2017 highs, but on a short-term basis, there is risk that the market will want to see some form of a correction, particularly with that gap from the weekly open still not being filled. Sterling dollar. So cable has seen its major breakout in 2017 after taking out the 2016 peak at 27.75, which had acted as the top of a multi-week range since the market had bottomed out by that plus 30-year low at 118.40. And so the break above 27.75 suggests we could be seeing the formation of a major base here, and this could open the door for the next major upside extension towards the 135 area, which would be a measured move following the consolidation that we had seen before the breakout between October 2016 through to April of 2017. But at the same time, there is risk for pullbacks, though these pullbacks now should be seen as opportunities for higher lows and fresh upside, with setbacks supported ideally in the 125 area. Only back below 23.60 would really compromise the constructive outlook that is now formed for sterling dollar. Dollar yen. So dollar yen has seen setbacks extend thus far down into the 108s. Overall, the market does remain confined to a downtrend right now on a shorter term to medium term basis despite this latest bounce. And so while the market holds below 112.20, there is still risk for a lower top and resumption of declines. At this point, there are many out there looking for the market to bottom out and for significant upside ahead. But again, it's important to note that the market has yet to take out that previous important resistance at 112.20, which does suggest that we could still see the market top out and head lower to fresh downside and fresh 2017 lows. Even if we do take out 12.20, it'll be important to see that the market closes above if you're looking for bullish confirmation. Otherwise, again, despite this latest rally, there is still risk that the market stalls out and once again heads lower. Euro Swiss. So some significant upside in Euro Swiss over the past several days, and it is worth paying attention to. If the market can now start to establish back above 109, which was a previous lower top, then this would compromise any downside pressure and suggest that the market is looking for a more constructive tone going forward. If, on the other hand, the market is unable to establish above 109, we could yet again see the market stall out and trade back down towards some amazing support just ahead of 106 in the 106.24 area, which was that 2016 low, which if broken would accelerate declines significantly towards the 104 area. Aussie dollar. So Aussie continues to show signs of topping out, with the market once again in 2017 well capped up towards some significant resistance in the 78 area, and this latest round of setbacks suggests we could see an accelerated decline below some key support at 74.75, which if broken could set the stage for the next major downside extension towards the 70 area. At this point, any rally should be well capped, with only a break back above the 76 area to take the immediate pressure off the downside. Dollar CAD. So this is the dollar CAD weekly chart, which is a good chart to show given the latest developments. The breakout that we've seen in recent trade above the previous peak at 35.99 from December, and certainly a break to fresh 2017 highs now, sets the stage for the next major breakout in this market that could take us up towards a measured move in the 140 area. So this is a significant area to watch. If the market can't sustain above 136, then we could see another pullback and consolidation. But overall, there are signs that this breakout could lead to a fresh upside extension towards the 140 area. Any setback should ideally now be very well supported ahead of that previous higher low at 132.24. Kiwi dollar. So Kiwi setbacks have accelerated to the downside, and the market is now focused on retesting and breaking some medium-term support at 68.62. A break of that level will open the door for fresh downside towards the 65 handle, and any rallies that we do see now should ideally continue to be very well capped ahead of resistance, which is now forming in the 71 area. SPX 500. The S&P 500 has rallied back sharply, and as we had warned, the pullback that we had seen over the past several weeks was only a minor pullback and did not compromise the longer-term uptrend while it held above 2320. Inability to break below 2320 kept the pressure on the top side and does leave the door open for a fresh record high and push towards the next key major barrier at 2500 further up. At this point, it would take a break back below the low that we had seen on Monday, that 2368 area, to officially take immediate short-term pressure off the top side. Until then, the market remains focused on fresh record highs. If we did see a break below 2368, though, it would do nothing to compromise the bullish outlook on a medium-term basis, and again, a break back below 2320 would be required to force a shift in this structure. Gold. So gold has seen some minor setbacks in recent trade, but the setbacks are viewed as corrective as the market continues to show signs of basing out off that 2016 low just shy of 1100, making a series of higher lows and then higher highs, higher lows, higher highs. And so this latest setback is once again expected to be supported with the most recent break above the previous 2017 high at 1265, setting the stage for a more immediate test of a measured move objective at 1335, just shy of the 1375 2016 high. So any setbacks that we do see over the coming sessions are ideally expected to be well supported into the 1230 area, but ultimately only back below 1195 would compromise the constructive outlook for gold.